Hey folks, welcome to verifiedinvesting.com. My name is Gareth Soloway, Chief Market Strategist here. In today's video, we're going to deep dive into the charts on oil and natural gas. Natural gas has broken out and I have an upside target, and oil is putting in what we call an inverse head and shoulders pattern, which signals upside is most likely coming. Now, again, the reason for this upside in energy, you could talk about the economy. I don't think that's it. I think it's the data center need for energy, which is going to zap the grid and cause more emphasis on natural gas and energy supplies that will again see a rise in cost for you and I. All right, so let's get into it right now. Here is your oil chart. This is again your US oil WTI crude chart. And the first thing that I see on the chart is that inverse head and shoulders, right? For those of you that don't know, this is your inverse head and shoulders. Basically, it's an upside down person. There's your head, here's your shoulder and shoulder. Now, the kicker to this is that when the neckline breaks, that's when it triggers, right? So as of now, we're trading here. It has not triggered yet. Let me get rid of the lines here so we can see this as clear as possible. So the key is that when price closes the day above this trend line around 62.40, this would trigger, and we can do a measurement to figure out the upside target. All right. And again, this is probability based. So what we do is we basically take a line, a vertical line to the neckline from the low of the head, and we take that, and upon the break, wherever the break is, if it's here, it's here, this would be your upside target. Now, what's so interesting about that is notice how the upside target coordinates beautifully, basically with this zone right in here, right? So again, you have this high and this area, and that again brings us right into this zone, basically around 69 to $70 a barrel. So again, if we break above this neckline at 62.40, look for a move up as high as 69 to $70. Now, this is near-term analysis, and I want to be crystal clear on this, guys, is that I am a technician of the charts. Essentially, I am a guide to charting and technical analysis. And this gives us probability. So we know that inverse head and shoulders, if you see 100 of those patterns, generally about 70% of them will work out. If they break that neckline, a good chunk of those go to those targets, like we talked about, the $69 to $70 level. Now, this is a short-term chart analysis. What we can do is we can go to a bigger time frame and get the bigger bias. So near term, the bias is slightly bullish on oil, right? Slightly bullish till we break the neckline, then very bullish until $69 to $70 a barrel. If once we achieve that, or if we don't break the neckline, we have to look at the bigger picture. Like this would be the move over the next 3 weeks, let's say, to the upside. But what about over the next 3 months? Where could oil be headed? And what we want to do here is we want to basically go to our weekly chart. And when you zoom out on time frame, right? When you zoom out on time, you're going to see the bigger picture, right? Which makes sense. Like if you look at something under a magnifying glass, you see like the fibers of the couch, whatever it is, you know. When you go back further, you see the whole living room, right? The whole, there's a chair, there's the couch, there's the TV, etc. And that's the same thing with charts, right? We want to see the bigger picture to get our overall bias. Now, when we zoom out on the weekly, the first thing that I see here is that basically there's been a pivot zone, right? So we can look at right here. And basically we've been hovering inside. So here you had chops, then you broke down. This was your COVID collapse. We roared back. We got above this level. It became support. Then we're now inside of this level. Essentially, what I'm saying to you is that we're kind of hovering in this sideways period where the market, again, gives us this bias of kind of neutrality midterm. But really, if I'm looking at this, I'm saying, wait a minute, there's some chart patterns that are starting to look problematic. First things first, we have a parallel, right? Look at this parallel. This tells me that eventually we're going to go down to this low end, which is below $50 a barrel, right? So again, high pivot to high pivot to high pivot, low pivot perfectly aligns with low pivot. And this again, if we factor this in, so even if we rise, and by the way, look at this, look at how cool this is. All right, check this out. So what price, if we bring this over here, let's just say in the next few weeks, we rally up here on the inverse head and shoulders. What price is this? This is right around $70 a barrel. Then imagine we dump out to the longer one. Where do we go? All the way down to $48 to $47 a barrel, all while staying within this zone, right? All within the zone inside there. Very cool to see that, by the way, folks. I love how the charts guide us. Now, The question is, does that tell us that the economy is obviously slowing? I would say in general, yes, it does. It does tell us that oil, again, if you look at gold, if you look at other commodities, any commodity that really is not too tied to the economy is doing very, very well. Gold, silver, you could argue silver's a little bit tied, but it's also a metal that's precious and people use it as a store of safety in an otherwise uncertain fiat currency model. But again, if you look at copper and oil, both of those charts longer term are looking bearish. Okay, a couple other things to go over here. So if we continue to drop this, we can follow this. But the question is, do we break eventually to the downside? Where do we ultimately go? And what I like to do, I kind of cancel this out because this was that weird COVID scenario where oil actually for the current month went negative. But what about a trend line? Let's go back to 1998. What if we connect this through? And what we can see here, folks, is that you have a beautiful low pivot right here from 98. Then you have this low here. And by the way, after 98, we started a huge uptrend. After 2016, we started a pretty solid uptrend before the COVID collapse. And then look at this, right after here, we started another uptrend. And so this seems to be a level where we're focusing in on that makes sense that that would be a major low. And essentially what we can do here is we can say, all right, well, if we expand this parallel, we just drag it out and we drag this trend line out, look at what happens here. These two lines, they meet right over here around $40 to $41. And so I would surmise that while near term, the bias is signaling upside to about $70 a barrel right here, then longer term, we come down, we bounce, we kind of come around, and eventually we come down into around this $40 per barrel level. Now, again, does that mean recession? Chances are it does. And I would just throw this out to you. If you look at the equal weight S&P versus the S&P itself, remember, equal weight means every stock in the S&P is equal. The underperformance is palpable. Now, why? Well, because the AI stocks are taking everything and essentially lifting the S&P, while the equal weight is way down from the S&P 500 levels. Essentially, what we're seeing here is that stocks like Wendy's, McDonald's, Procter & Gamble, Chipotle, I mean, you could go on and on and on. All of these consumer staples that are very kind of influenced by weaker economics and consumer spending, they are all at 52-week lows or close to 52 weeks, some at multi-year lows. And that to me is telling me something about the overall economy. All right, what I want to do now is change focus into natural gas. Now, nat gas has had a great run from these lows of 273. We're currently trading at 430. But I want to show you this, guys. If we flip to our weekly chart, look at this beautiful trend line here, right? Look at this down sloping trend line right here. That, my friends, is a beautiful breakout. Do you guys see that? You have your high from 2022. You have your high here from February of 2025, your June high, and then we hit it right here. We kind of stalled out, and then we broke out. That is a breakout. Now, how high could natural gas go before it starts to run into resistance? I'm going to show you absolutely right now. So what we do is see these interim levels where we had this big pop, we fell, big pop, fell, big pop, smaller pop, but still a pop, and then we collapsed. That now becomes resistance. And what you want to do is you want to just kind of take note as a technician. You don't want to get overly confident that, oh, it's got to go there, because there is this lower pivot right there as well. And so what I'm looking at here is you have an upside target on natural gas to this level here at around 492 to 530. So anywhere in this zone, that's where natural gas is likely headed. And again, we talked about the data center angle of this and why that is the most likely scenario of where this is going to go. And to me, at least, that speaks a lot of truth, right? That we're likely going to go in that direction. So this is, again, a beautiful technical breakout. It is already on the move. So like, some people, this is the daily chart now I'm flipping over to. Some people are saying, oh, well, I should buy it now for this move up. I don't do that. I don't chase. What I do is I wait for pullbacks, right? So inevitably you get pullbacks. And if you don't, then it's just a missed trade. It is what it is. But what I don't like to do is I don't like to pay up so much, right? So if you think about this, natural gas from just August 25th is up 60%. There's no way I'm buying something up 60%. I don't care what anyone says. What I would do, however, is if we get a pullback Here, absolutely. No brainer. Gap fill, down sloping trend line. That's a buyable level for a move up. Or even you could even get more aggressive and right at this low at around 380, inch in and then buy more gap fill down here if it were to come into those levels. So there's lots of ways to play it, including avoiding it. There's nothing again wrong with saying, oh, it's already run too much, I'm going to stay on the sidelines. I'm just again passing along how I trade. And again, I'm very disciplined. I want something basically into the key support level or just at the breakout point. Otherwise, once it's run, I'm not going to be one of those people that buys late and becomes a bag holder. I don't want to be that. Naturally, inevitably, occasionally that does happen. Unfortunately, we're humans, but I think the idea is that the more disciplined you are, the more selective and the more you demand price to come to your level versus just being like, oh, I'll just pay whatever, right? I mean, again, think about that. Imagine if we went to the supermarket and we're like, oh, eggs are now $100 a 12. Sure, I'll pay that. I'm like, who would do that? No one would do that. We would say, you know what, I'm just going to not buy eggs this week. And instead, when it finally pulls back to a reasonable price, I'll buy eggs or I'll buy milk or I'll buy anything. So we all make those choices in the grocery store, in the mall, when we're buying jeans, new jeans, whatever. But for some reason in markets, we tend to chase because emotion gets involved. Focus on discipline. Don't let that emotion get you. It will ultimately cost you money. Promise you that. All right. Have a great one as always, guys. Thanks for tuning in. Hope you learned something here. Share it with friends and family if you wouldn't mind. Much appreciated. Take care.